is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello and welcome back to another episode of DeFi Decoded. I'm Alex Tapscott here with co-host Andrew Young. Andrew, it's been an absolute whirlwind this past week. Markets have been up, markets have been down. One of the big stories that we're paying attention to is the increasing evidence that's building that there is a decoupling going on between Bitcoin and the rest of the broader market. Now, today, the day we're recording this is Tuesday, April 22nd. The NASDAQ is up, the S&P 500 is up, Bitcoin is up. So it looks like everything's kind of moving together. But over the last few days, we have seen this very interesting divergence where Bitcoin is starting to look a lot more like gold, an asset that is not necessarily wedded or tethered to the US dollar. It's global, it's decentralized, and we know that it's widely held around the world. And perhaps this is the moment where it's starting to emerge as an alternative to traditional US dollar-based assets. Until today, most other cryptos haven't participated as much. We're seeing a little bit of catch-up trade happening, but Bitcoin dominance is still over 60%. It's at the highest it's been in a very long time. So at least for me, the crypto story is very much a Bitcoin story. There's obviously the macro backdrop of tariffs, of slowing growth, and of a million other things, which we are going to get into on this call. We're very, very fortunate to have a special guest who joined us on short notice, someone with a huge audience because of his deep insight and really kind of prolific posting commentary about the state of the world, crypto markets, you name it. Scott Melker. Scott Melker, known as the Wolf of All Streets. He is a trader and investor, the host of the popular The Wolf of All Streets podcast, the author of the Wolf Den newsletter, and as I said, a prolific writer and thought leader in the crypto space. He has been featured on Fox Business, in the New York Times, Forbes, Business Week, the Wall Street Journal, CoinDesk, Cointelegraph, you name it. He was named Influencer of the Year by Binance and has been recognized as a leading voice in crypto and beyond. Scott, we're so grateful to have you on the show to help make sense of this crazy time. Welcome to DeFi Decoded.
Thanks. I would have just said a guy who talks about crypto a lot. So that was quite a few random accolades that I've long since forgotten about.
Well, you may have forgotten about them, but I haven't, and your audience and our audience certainly has not either. So, Scott, I mean, I talked about the thing that I'm paying attention to right now with this big story around the decoupling. But why don't you tell us, like, what is your snapshot in time of where the market is at, and what are the big indicators that you're tracking at the moment?
To be quite honest, I've never bought the narrative that there was a coupling of any sort. So decoupling is a bit nonsensical for me, although it's something that we always have to talk about.
Right.
If you look at a chart of Bitcoin versus the NASDAQ, so Bitcoin divided by QQQ, it's currently breaking an all-time high after breaking an all-time high 3 months ago. And it's breaking an all-time high that it made in 2021 when it just broke that 3 months ago, which broke an all-time high from 2018. And it's gone up many, many multiples more than the Qs over that time. Since the existence of Bitcoin, it's a chart up and to the right, like any parabolic chart, making higher highs and higher lows against tech. So if they were correlated assets, you would expect effectively a flat line, right? They would trade together. They would be basically the same thing. Yeah. What you have is the same thing that you see in a Bitcoin chart versus a dollar, a Bitcoin chart versus effectively any other asset. So the notion that they're correlated in the first place, I object to, right? They obviously have times of correlation. We all know that in any black swan event or any major macro event, all correlations go to one temporarily before decoupling again, so to speak. And if you look at a Bitcoin to gold chart, obviously, that's looking the same, except for that over the past year or so, gold has absolutely smashed Bitcoin. Yeah. Certainly over the past few months after Bitcoin did make a new all-time high against gold. But you have the two narratives, digital gold, and then you have the other half saying that it trades like tech or it trades like the Mag 7. It's just another tech stock. And if you factually look at the charts, it looks like neither. And it's a disservice, actually, to call it either as far as price and trading are concerned. Now, I do think Bitcoin is digital gold from a narrative perspective and from a qualities perspective and from a value perspective, but that should not be conflated with the idea that its price should follow gold or that gold's price should trade the same, right? It's a better version of gold in every single way, but that doesn't mean that the prices are going to be correlated when they trade together. So The decoupling is interesting. I've been talking about it. It has been very clear since Liberation Day, since Trump kind of announced the widespread tariffs, that Bitcoin has not traded like anything but Bitcoin, right? Because as much as it had that short dip down to about 74, it was a V-shaped recovery, but largely Bitcoin basically traded between 82 and 85,000 while markets were in complete turmoil around it, and then rose much quicker than everything else. It was even, trading at 88, 90,000, and stocks still to today, but at no point have gotten back before their Liberation Day prices, not even close. So it's very clear that there's been no correlation, even in this black swan event.
Yeah, well, I mean, so I take your point, and I actually agree with you in the long term that, and we've done the analysis too, that the Bitcoin and the NASDAQ over time have not been generally that strongly correlated. But as you point out, like when things are going to hell in a handbasket, most assets kind of go down together. And this cycle has been really interesting because even in the past, times when we've seen a risk off and a flight to safety, gold has suffered, Bitcoin has suffered, bonds even suffered, and only the dollar itself did well. And this time it looks very like the composition of the sell-off looks very, very different. And even in a moment, in a period when equities have insanely high volatility or generally on the downtrend, Bitcoin outperforming does feel noteworthy, even in that moment. So I think that maybe we're both right.
Yeah, I actually wasn't even saying it to you because you and I have talked about this.
Yeah.
Many, many times. I know that you don't believe that they are closely correlated assets over time. So I was actually echoing something you and I have discussed in the past.
Yeah, of course.
I just think it's interesting that people are so focused on it right now, myself included, because I've pointed it out so many times, are so focused on it now when historically that's just how it's been.
Yeah, absolutely. Andrew?
Yeah, I'm curious. What do you think about the other decoupling, as in Bitcoin going up and every other crypto asset going down, or at least dramatically underperforming Bitcoin?
So something I was horribly wrong about, right? And I think many people are. And I always said about sort of the 4-year cycle and that notion that, if it ain't broke, don't try to fix it, but that there will be a time when the evidence may show us that that cycle is no longer intact. And I think that the evidence has shown us that, unfortunately. So I totally expected that we would have the halving, we'd have the election, global liquidity would ramp up, all the things that have generally happened in a 4-year cycle, whether that's because of the halving or it's because of the election, who knows? But those things all coincide sort of in this 4-year cycle. But what we would have seen in any other 4-year cycle is that Bitcoin would have, first of all, Bitcoin made an all-time high far too early. So that should have been a signal, and that was because of the ETFs. But after making that high, 109,000, you would have expected a huge bid on altcoins, right? Because in the past, it was pretty much just crypto natives that were trading. So we all know it was a washing machine of money, right? Bitcoin would get to a certain point. People would get bored. They'd either try to outperform Bitcoin or try to compound Bitcoin by buying altcoins. Altcoins go way up. They sell those back into Bitcoin. Bitcoin has its run up. So every time Bitcoin's consolidating, especially after a move up, you would see altcoins just wildly outperform. That hasn't happened at all this time. There has been no 4-year cycle. There's been no bid on altcoins at all, except in the degenerate meme coin casino on Solana. And this makes a lot of sense. So what we've seen, in my opinion, is a complete barbell, right? So we have Bitcoin on one side of the barbell, and makes a ton of sense that Bitcoin and Bitcoin dominance would rise because we all know that there's factually new money coming into Bitcoin, right? The ETFs have opened tens of billions of dollars of institutional interest. United States talking about strategic Bitcoin reserve. So we know institutions, sovereigns, and then retail as a proxy are buying Bitcoin, right? But in the past, those would have been a bunch of crypto natives who, like I said, would have trickled down into altcoins. But you can't sell your IBIT BlackRock ETF to buy Doge, right? So there's really no way for that money to even trickle down if it wanted to. And those are not the same participants as they were in the past, right? So what you have is Bitcoin getting all this new money, all this new attention, and that money is staying in Bitcoin this time. On the flip side, what we've now sadly had to admit that for all the utility and excitement about projects and layer ones, which I still do believe in, that we've had in the past, the price action on those was simply gambling and speculation, right? So it was the crypto natives looking for the next thing to pump, trying to find a way to just make a ton of money in the market. Well, sadly, all of that money that was once in utility tokens has gone into meme coins, and there's a reason for that as well. If you think about in past cycles, everybody new came into crypto through Doge and NFTs. That's what happened in the last cycle. No matter how much Bitcoin maximalists want to believe that Bitcoin was adopted, if you ask any exchange CEO from that time, there were 3-month waiting lists to sign up to a centralized exchange so that people could get Doge, period. That's why people were there. They wanted access to it. The difference this time is you don't need to sign up for a centralized exchange to trade a meme coin or to buy it. So because that has become so decentralized, because we have pump.fund, because the UX and UI on Solana is so clean, anyone can go and buy any lottery ticket meme coin they want immediately, and it has made the cycles on those tokens days instead of months or years. And it has obviously brought positive attention to some degree because more money coming in, but a lot of negative, bad actors, negative attention. So I think all the people who used to have to speculate on utility tokens, as we called them, they're now speculating on memes, and it leaves no new money for anything we actually deeply believe in that's stuck in the middle. I don't think that means it's not going to happen. I'm just saying we have to be intellectually honest about what has happened.
Well, yeah. I agree with you on that. I mean, I want to make it just a couple of points here, because I thought that I don't think I've heard anyone articulate the point that you did, at least as well, about how the IBIT money, the money into the ETFs, doesn't like trickle down. Like, people have had that wealth effect because on average, the average buying price on that ETF is well below where the price is today, and certainly well above the all-time high. And yet there hasn't been this like natural cycling of the cash into something else. One could argue that it could have gone from IBIT and the other Bitcoin ETFs into the Ethereum ETFs, but I think Ethereum specifically is saddled with all sorts of issues, narrative issues, and maybe even fundamental issues that don't make it the obvious choice for a crypto native, and especially for the prototypical boomer investor who we think owns this IBIT and related funds. And then obviously there's no way for them to do that in the listed market. But we have seen, Scott, certain crypto equities, which are accessible to those kinds of investors, do extremely well. MicroStrategy being the most obvious example of that. But in addition to that, at least until the last couple of months, all of the Bitcoin miners were near all-time highs. Galaxy Digital was at an all-time high or like cycle high. And in Canada, where we are, there have been some of these companies that have given investors exposure to assets like Solana that have done incredibly well. And I think that's an example in a way of that cycling effect happening. So I wonder and I know Andrew wants to jump into it, but just to you, like, does increased availability of publicly traded ETFs, Solana ETFs, for example, and also public companies that give exposure to crypto, will that make it easier for the TradFi investor to do what crypto investors have done in the past, which is to take their winnings and roll them into something new?
To some degree, but I still think that the market share that Bitcoin holds of that entire market will remain somewhat static. So I think that largely the new entries will cannibalize themselves or will remain on a percentage basis as the entire AUM of all crypto products grows. The percentage that is in those other ones will grow. So they'll naturally grow, but I think that they'll take money more from each other than they will from Bitcoin. Most of those things that you named are beta plays on Bitcoin, right? So those are things, miners, MicroStrategy, specifically.
Those ones are for sure.
Yeah, are specifically things that people buy because they want a higher beta exposure because they already believe in Bitcoin and believe in it so much that they want to leverage it, right? And take a bet if Bitcoin's going up, well, maybe these will go up 1.5 or 2 times as much, right? So there's not really that many ways to truly gain exposure to the rest of the crypto market, except for the Ethereum ETFs. As you said, Ethereum has its own litany of issues. So I don't think we can extrapolate what's happening to ETH to all altcoins. Yeah. But we can say that Ethereum did not grab any meaningful market share of the ETF market, even though they were the second to enter, right? The interest has remained with Bitcoin. I think it's great that we're going to end up with Solana and XRP and Doge and Bonk or whatever other ETFs we get. But just because the product is offered doesn't mean it's going to be successful. I mean, there's thousands and thousands and thousands of ETFs that die, right? And they're not, just don't think there's going to be that much interest in a lot of those. The thing is, the further you get beyond Bitcoin and Ethereum, you're really getting to people who understand crypto. If you want to buy Hedera or XRP, like, you've already found a way to do that. You're not like waiting for an ETF to appear to finally get that Ripple position or XRP position that you've been dying to get, right? So I think they will grow, but as I said, they will grow as a function of the entire market growing. But I don't see, like, let's say Bitcoin has 90% market share of the ETF market, or maybe call it 80 for being a little bit liberal. At $1 billion, great. Then, or call it $10 billion, $100 billion. Bitcoin will have, 800 million of it, and altcoin ETFs will have 200 or whatever. If that goes up to 100, it'll just be the same proportion, but more money in both.
Yeah, that's interesting. I think one of the things that has been the most interesting has been just the fact that this divergence with Bitcoin, and to me, I think I agree with everything you said. I think one of the bigger things, though, obviously, is also just like the global liquidity cycle hasn't really been there with this cycle compared to the last cycles. And that's why you almost have these like really small scale games, like memes of. What's interesting about the sort of the meme coin frenzy was it was actually relatively small. There was no real like $100 billion meme coins, the same way that there was, $150 billion Cardano or whatever the market cap was in the last cycle. And there was obviously kind of like an AI summer as well, where for a month or two, like AI agents were getting bid up a ton. But for the most part, it was actually a relatively sort of small frenzy. I would sort of say, at least relative to like the market cap of Bitcoin. What do you think though of kind of like the Arthur Hayes camp of crypto analysts who think that, first half of this year is going to be very rough, but then something's going to break, and that's going to essentially force the Fed to restart QE, whether it's stealth QE or not. And sort of we're going to get this like pickup in the global liquidity cycle, similar to what we had last cycle. And that's kind of like the final catalyst to get us to, i.e. Bitcoin 250K, which is Arthur Hayes's sort of target, but then also finally get this like altcoin cycle.
Well, from the charts I've seen, and I love the work of Arthur and Raoul Pal and all these people, but admittedly, nobody knows what the future is going to hold, and everybody updates their predictions based on what's happening at any given time, right? So we quickly forget the predictions those people had, myself included. They were much higher before they said it would go much lower when it did, right? So I take everything with a grain of salt because we all lack the crystal ball that we would need to make those predictions. But from following the global liquidity charts, we did have a tightening, right? And so it makes sense that altcoins, especially the more speculative end of crypto, would have suffered during that time. From what I've seen, usually you see an uptick in global liquidity in M2, which has happened, and crypto and Bitcoin trail it by about 3 months. And I think that hits right about now, right? So I think that the tariff nonsense maybe puts a little dent in that, because I think that Powell cannot cut right now, or certainly doesn't think he can. I also think that the Fed has effectively been neutered, and whether they cut or not is almost irrelevant because the economy is so fiscally dominated and the liquidity is going to come from there and all of the tariff talk. But let's say they do start massive QE, which they're concerned with inflation, so I'm not sure that will happen. I do think that obviously raises the prices of everything. Listen, the best runs always come when there's a ton of liquidity and people feel rich and there's the wealth effect and they start going further down the risk curve and buying more speculative assets. I'm just not sure that the Fed can do what people need them to do right now. And I think they would have. I think without the tariff nonsense, I think that Powell was probably ready to cut, in the next month or two. And I really think he won't. Even Bank of America today came out and said they don't expect any Fed cuts this year. I don't know. Seems like, Trump really played his hand, and both China and Powell called. Whether it's a bluff or not, I don't know, but it seems they both called. I think that they really expected that Liberation Day would come and it would pressure Powell into cutting and it would pressure China into a deal, and we just haven't seen that yet. We've just seen an escalation. So I think in theory it works. We need to really see that liquidity come in, though.
Yeah, I think I agree with you. Also, I think like inflation's to me has kind of pretty clearly rolled over.
Well, based on a pre-tariff sort of assumption, right? Like
right.
The trend was the trend was our friend.
Yeah, that's exactly right. That's why I'm saying I think Powell.
Scott, like if we had the inflation prints that we've had without any of this tariff backdrop, there'd be like they'd be cutting pricing in like even more cuts this year. Like markets would be mooning. Just generally, I don't know how crypto specifically, but generally it would be risk would be on.
Yeah, I think there is. I mean, there's I guess one last sort of follow on to this too. To me, the bull case for the second half of the year is somewhat clear. I think you for sure need tamping down of tariff nonsense, whatever you want to call it, over the next kind of couple months. Hopefully that sort of starts to fade away. And then, the market's very fickle. Like attention could shift to the deregulatory agenda pretty fast, which I think everyone sort of thought was going to be the main focus post-election immediately. And so, I think like a shift in attention away from sort of the tariff stuff to the deregulatory agenda, that's a pretty good catalyst. We're also, I think we're only 12 months away from a new Fed governor coming in, sort of being elected, who presumably will be far more dovish. I guess, what do you think of the idea that the U.S. has sort of like lost some credibility permanently from this whole...
I don't know that anything's permanent, but I mean, I think that what we've been doing is nonsensical, right? I don't know, maybe you can make the argument that it's directionally correct. I sympathize with the argument that trade should be fair and that should be equalized on a case-by-case basis with different countries around the world. So directionally, I guess I can sympathize with the argument, although I generally disagree with it, and I can tell you why. But taking a sledgehammer to every country in the world all at once doesn't make much sense to me. And it would make sense with me if the messaging was consistent from across the administration, but it wasn't, right? If you have Lutnick and Navarro saying, we're going to have an external revenue service, which, by the way, makes absolutely no sense because American companies pay the tariffs. The foreign countries don't, and people don't seem to understand that. But, okay, let's pretend that we make enough revenue from tariffs to get rid of the IRS. Then you would expect these to be permanent policy. You wouldn't have Besant and Trump on the other side after saying those same things, by the way, saying this was just a negotiating tactic to get everyone to the table to get free trade. So I think the tools they used were wrong, and I think that they did not have their messaging consistent to do it in a way that the market would trust them. So I do think there's a lack of trust there. The bigger issue that I take with the tariff situation, I guess before more directly answering your question about trust, is that the trade deficits are nonsense, I think, if you really understand the way the world works. So we may not export goods to Vietnam and Cambodia, but we export inflation and the global reserve currency, which is a much more powerful export. The notion that in some way there should be equal buying of American goods by a poor Vietnamese person who's making our shoes for $1 an hour is complete nonsense. When you have the global reserve currency, you naturally are going to have trade deficits. There's a Triffin dilemma, I believe is what it's called. But basically, when you have the global reserve currency, you're naturally going to devalue the currency by having to export that currency to the rest of the world. And eventually you get to a point where that's unsustainable. That's where we are. It's the case of every global reserve currency in history. But we are exporting something much more insidious and dangerous to everyone in the world that they're forced to use. They don't want to have to take the dollar and our inflationary policy for everything that they do. Ideally, they would love a hard currency that was going to appreciate and not depreciate in value. So we're really the ones forcing our export on them. We can go buy our goods anywhere. They all need our dollars. So it doesn't make much sense to me. I guess on paper, yes, it should be fair. But what is fair when you're in control of everyone's money.
Yeah, the idea that like Vietnam's ripping off the U.S. is ridiculous. Like it's these are small poor countries doing things that no American worker can do, no American business could do profitably in the United States, and we get that we as in North America, high income countries benefit way more from this relationship.
We consume everything. They consume nothing. I mean, we're consumers.
Yeah.
So of course we're going to be importers.
The China issue is an important one, and China does run this massive structural trade imbalance. It dumps goods. It doesn't always obey the international trading rules, so on and so forth. Like, so I get that, but
I agree with that.
As you said, like the implementation of this whole program was completely incoherent. To your point, everyone within the administration has a different rationale for this. It's for revenue, it's for fairness, it's to target China specifically, it's to target everyone. Like, it's totally incoherent and all over the place. And also, and I think more importantly, it's actually doing, I think it is doing or will do lasting damage to the U.S. in two ways. Number one, if these China tariffs stay on for any more than a few more months, it will be Armageddon for small and medium-sized businesses in the U.S. Many American companies manufacture their goods or buy inputs from China that go into goods that are assembled or manufactured in the United States. So Flexport, which is a shipping logistics firm, the CEO has been really vocal on this issue. He said that they estimate $600 billion of landed goods arrive in the U.S. from China every year. That probably translates to over $2 trillion of sales of finished products in the United States. The benefit of this is, and again, to who's benefiting the most from this, the irony is that most of the stuff is made in China, but the companies that actually benefit the most from those sales in the U.S. are the firms that market them, which is to say the companies themselves, right? Like, most of the value capture happens at the last sort of mile of the process of the good being built. So what you're doing in effect is basically, Apple is $200 billion. It's a country unto itself in terms of its financial resources. It can endure, it can negotiate, it can lobby. Small and medium-sized businesses making, and I'm talking about companies making up to several $100 million a year, don't have the ability to get exemptions for, strollers or get exemptions for other sort of things that are made in China. And those kinds of companies simply cannot make money when tariffs are at 145%, because it means that they're paying 2.5 times what they were before for either the inputs or for the finished product itself. And so there will be a massive wave of bankruptcies of small and medium-sized businesses. And then the other thing is you want to improve your manufacturing base. Something like I think I don't know the exact data, but it was most manufactured goods in the U.S. have some part that came from somewhere outside of the United States, right? That intuitively makes a lot of sense. And why, force all your manufacturers to put one hand and tie it behind their back? Basically, you're saying we're going to increase the cost of the stuff that goes into what you make in the United States. That's not making manufacturing more competitive. It's making it less competitive. So anyway,
and it's good, and without deregulation, it's going to take 5-10 years to build those factories anyway. So
yeah, and and to your point, should the U.S. be making more cars, chips, robots, drones? Sure, why not? But should be making sneakers and underwear and bras and little plastic toys? Of course not. Nobody wants those jobs, by the way, in the United States, which is another funny thing. There was some data in the FT that said something 80% of Americans say the country would be better off if there was more manufacturing jobs. And it's only 10% or something said they'd be better off if they worked in a factory. Nobody wants to work in a factory. And this is something funny that Gary Cohn, who was, senior advisor to Trump and Trump won, tried to remind Trump of. It's look, if you're given the option between working in a climate controlled environment in a chair looking at a screen or being on your feet for 10 hours a day in front of a blast furnace for the same pay, you're going to choose the office job. Men don't intrinsically want to be on a factory floor screwing things together. People will go to the thing that offers the best pay, the best, work-life balance, all the rest of it. So that's a more philosophical reason. The country shouldn't and probably can't ever do what they wanted to do. And the implementation of this program is certainly not helping.
Yeah, and by the way, a lot of those jobs are in Vietnam and Cambodia, the places that are apparently taking advantage of us because of the Trump tariffs from 2018 to 2020 on China.
That's right. Yeah,
And,
they flowed to sort of related countries.
and those companies, like American companies, decided to go along with the Trump administration, and some of those companies just moved out of China, but to utilize and build the resources in Vietnam and Cambodia. So imagine being one of them and saying, we just moved these to another country a few years ago because of the war against China. Now you're dropping the hammer on everybody, right? And we can look at the tariffs from 2018 to 2020, which, by the way, like philosophically, absolutely, China is taking advantage of this. I understand that. So I'm not saying they're right or wrong. Biden kept them on. It's not necessarily a Trump thing. But what it resulted in was China saying, we're going to put tariffs on certain American agricultural goods, and it required $30 billion in subsidies from the American government to American farmers because of the tariffs. So we spent $30 billion to help our farmers for the business that they lost because of our tariffs against China, which is A, hurting our farmers, and B, stimulus, printing money to bail us out of a problem we created. So it's just not that simple.
Yeah.
So shifting gears a little bit, two questions. One is you sort of touched on it a little bit earlier about ETH underperformance. Really want to hear your opinion, kind of like
it.
on the next 12, 24 months on Ethereum. But then also second, sort of further to that, besides Bitcoin, what other areas of the crypto asset class are you most excited about?
It's been really hard. So I think that everybody has taken at least a slight detour towards Bitcoin maximalism throughout the past 6 months or years, because it's just been the safest and easiest place to be. And I think all of us are Bitcoin maxis at heart, right? So I've always said 70%, if not more, of your portfolio should be in Bitcoin. Maybe I amend that to 80, but I definitely think that Bitcoin.
Well, you don't have to amend it to 80; just the market will do it for you.
Yeah, it has, right? So exactly. I used to be 30% Bitcoin, 70% altcoins. I'm now 90% Bitcoin, and I've never sold anything. Yeah, that's exactly how that happens. So I think that ETH has had a philosophical struggle. To be quite honest, I've still remained an ETH fan. I've held my position. I've said, listen, I look at a chart. It's way oversold. There's all these signals. It should be bottoming. It just hasn't, right? It has the ETF. I mean, it doesn't help that Vitalik is schizophrenic on social media about the future of ETH. He doesn't bring much confidence. There's definitely an argument that L2s have just eaten the lunch of the underlying protocol. So, I mean, ETH, what are the fees today? 0.01 a penny, not even a fraction of a penny to send a transaction on ETH. Can't be a profitable protocol with gas fees that low at the base layer. So ETH has a lot of problems. That said, Larry Fink's still tokenizing, real world assets and treasuries on ETH. That's still clearly where the money is. There's still incredible developer activity. I personally anticipate that it bounces, and it bounces big, but I've been saying that for quite a while, and it's done nothing but go down. So I'm not sure that my opinion on the future of ETH is particularly relevant. Most smart people I talk to say, yeah, run. At this point, even the biggest fans, but see, and then, when I'm told there's blood in the streets, buy the blood. When you hear everybody saying something that has fundamental values going to zero, you buy it, you plug your nose if it goes down another 20, 30%. So I still remain in that camp. I mean, maybe the day I capitulate on ETH could be the ultimate bottom signal, because I've been somewhat of not a supporter of what they're doing, just fundamentally, I just believe it should bounce.
Yeah.
And that there's going to be interest and there's going to be things built, but it's got some problems. Layer 2s have ended up being a big problem for Ethereum, because why do anything on Ethereum if you just go do it cheaper on a layer 2? Although I guess now it's just as cheap on the baseline.
Yeah. I mean, I don't want to cut you off because I know you're going to talk about the second part, but I totally agree. I mean, I think Alex and I are both over allocated to ETH. I mean, as you said, Bitcoin has sort of rebalanced our portfolio for us, luckily.
Yay.
To me, the whole ETH thing is really interesting. I just think they crushed their own tokenomics in order to massively grow their own L2 ecosystem, which they actually have, right? If you look at different measures of L2, TVL, transactions, all that. Like the L2 ecosystem's massively grown. It just hasn't really contributed to, revenue yet because they essentially like decided to crush their own fee generating capacity with the blobs upgrade last year. So to me, it's like, it was the ultimate kind of like sacrifice short-term token price for long-term growth. I thought the market would sort of see through that, but it hasn't. It's just punished Ethereum for that. Probably because I guess the market doesn't think that they can actually generate value from L2s sustainably. I personally take the other opinion. I mean, if your customers are all L2s that are businesses, you actually have much more ability. I would say it's a much stickier audience, even if it's a little bit more price sensitive versus just like meme traders who clearly are not price sensitive in terms of like paying fees and things like that to a certain extent. So I don't know. I'm still a big believer, but I do want to hear your sort of the second part of the question though on what other areas beyond Ethereum like are you kind of excited about?
Maybe I'm a glutton for punishment, but I still believe that all of the main layer ones will find specific product market fit and will have things built on them. So I still remain like
what are the main, when you say the main layer
Solana, ones? Ethereum, Avalanche, and I think that there's a newer round of those that are really interesting. Sui, Aptos, that whole family of new chains. So I'm really interested in all of that. I find it very hard for anyone to catch the thing that's going to do the 100x, the meme coin, whatever. But I'm still very interested in owning the underlying chain that thing might be built on, right? I mean, we've seen how well Solana has done just because it really caught the attention of the meme coin market. So I think that having exposure generally to these layer ones is probably the best way. Listen, I was really excited about Gunzilla. I don't know if you guys are familiar with it, but the gaming project, their game launched before the token. It's built on AVAX. I mean, this is a crypto native game that is a legitimate AAA game that was a top 3 game being streamed by Twitch streamers and a top 3 game in the store. Like literally you're talking about something that Fortnite, Call of Duty, like in the conversation with the big games, built on a blockchain, launched a token, and it's just flat. So I just can't be convinced right now that people care deeply about utility. That should have been the biggest launch of the year. You know, we waited years to have a AAA game built on crypto with in-game assets, and it just hasn't happened. So
is that on, did they build their own L1 using Avalanche?
I think they have there's their own L1, but the tech I think is built on AVAX, some guns.
Yeah. AVAX has this really cool, we actually talked to the AVAX team a couple weeks ago. They have this really cool thing where they Ethereum's really focused on building out their own layer 2 ecosystem, whereas AVAX is essentially allowing people to build their own L1s, which is kind of interesting because you would think like an L1 wouldn't want other L1s, but there's like a whole shared security aspect, and then obviously using their SDK, there's like some value accrual back to AVAX. But anyways, just wanted to shout out AVAX because I think it's a pretty cool model. Yeah, I've heard a lot of hype about Gunzilla for sure. I didn't realize the token launch has already happened and was sort of a minor event, I guess. That's really interesting. It is funny too because 4 years ago, if they had launched this, it'd be like a $10 billion valuation.
It'd be the biggest thing that ever happened ever. Yeah. I mean, I still think it's at 250, 300, no, maybe even 400 and something million actually. So it's not like it's tiny, but if ever there was going to be something that was going to be in the billions kind of, or that would be really like have one of those big up moves on the chart at launch, just didn't happen.
Yeah. What's really interesting is I think like there's a lot of really deep value sort of application tokens or smaller projects. The main thing that I'm seeing though, part of the reason why I'm seeing the market discount a lot of these projects to kind of a crazy degree in some respects, is people aren't really sure which ones are actually going to survive into the next cycle. And so if you're brave enough to sort of play in the small cap altcoin market, there is a lot of, I would say, dislocations from value right now.
Yeah, for sure.
The problem though is a lot of these things just seem to just keep going down. I just got kind of curious beyond I guess are you coming beyond sort of the like broad-based exposure to Bitcoin and then the L1s, which I think is like a pretty smart recommendation for sort of crypto investors, and a lot of our audience is sort of TradFi people who are interested in crypto. Are there any sort of smaller projects that you're interested in beyond sort of Gunzilla? Like, is there any sort of spaces that excite you the most?
There's very little. I mean, it's still the same as previous cycles. Like, I'm not excited about NFTs or metaverse or anything anymore, but I'm sure that they'll have their moment again. I think the cross section of AI and crypto is going to be very, very interesting. I'm just not convinced yet how to gain exposure to that and something that is a solid investment. But I do think that that's where the next kind of big things that will happen in crypto will come from. I just, I don't know, an AI that tweets like a real person and doesn't seem like the real like killer app for AI agents in crypto yet. So I'm waiting for that. But I think the cross section of AI and crypto, when we find the way to best invest in that, is going to be huge. I just don't know which token right now is going to capture that.
Yeah, I think you're certainly not alone in that respect. I think a lot of people might be looking at the underlying layer one network and say, okay, maybe it's Say or maybe it's Sui, where this is a network that seems to lend itself to like AI agents. And so I don't know which agent, but I'm going to buy the underlying layer one and I'm going to benefit that way. I think a lot of people have looked at prior cycles in a similar vein, owning Sol rather than owning meme coins, owning ETH rather than investing in individual DeFi projects. I think that we may see that narrative happen again. I did like your comment about individual layer ones finding product market fit around certain use cases. But again, like until there is a new wave of something exciting beyond just, ping-ponging money around the ecosystem, I think that, a lot of those names below the fold, below the Bitcoin sort of level are going to, be looking for direction. Like, I just don't know what the thing is that's going to like have them take off. But we'll certainly be keeping an eye on that here on the DeFi Decoded podcast. Scott, that was a really great discussion, man. Thank you so much for joining us, for all your macro insights, for the micro insights, big and small.
I'll just end up being wrong, but at least I thought about it.
So long as you've got a well-reasoned take and conviction, that's what people are interested in hearing about, right? We want everyone to go out there and make their own decisions, of course, but hope you enjoyed this discussion and learned a little bit from it. That's it for this week's episode of DeFi Decoded. Scott, if people want to follow you, I mean, they probably already do, but just let us know what the best way to do that is.
Yes, really just go to X and at Scott Melker, and everything else is kind of branched off from there, YouTube by the same name, but that's where you can find me.
Awesome. That's it for this week's episode of DeFi Decoded. Please make sure to share, like, and comment on the episode wherever you listen to it or watch it on YouTube if you want to see our beautiful mugs. Until next time, take care. Bye-bye.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.